What's going on, everybody? It's Jeff here. Welcome back to the channel. A $69 million bet against AMC was taken out Friday about 4.5 hours before close. And in this video, I want to talk about a new theory that I have on why potentially this position could have been taken out. Now, before we get into the strategy and what exactly the position was, I want to mention a few things here. So we've known for a while hedge funds have abused the options chain in order to do a couple things. One, hide their short positions, hide the real short interest. And the other reason why they did it was in order to help market makers stay delta neutral, which would inevitably prevent a gamma squeeze from happening. Now, a gamma squeeze happens when market makers become too delta heavy. They have to go out and start buying shares, which cause buying pressure, which leads a run up to the price. And a gamma squeeze 9 times out of 10 happens before a short squeeze happens. And we've talked about those theories numerous times on my channel and all over the internet, but I want to explain to you why I think potentially this bet could have been taken out. So let's get right into it. Before we take a look at exactly what that bet was, I want to give a quick refresh of simple options. On simple options, you have two strategies. You have calls and puts, and you can either buy them or sell them. And I know a lot of people watching this video have probably bought calls before, and you know that is a bullish bet. You want the price to rise. That's why I have an up arrow here. Well, when you are buying an option contract, there is somebody on the other end that is selling the contract that has an opposite interest of you. Therefore, somebody who is selling a call wants the price to go down. It is a bearish bet. And the inverse for put options. And as you can see, my arrows are a little bit different right here. Take a screenshot of this, save this for later. If you are interested in learning more about option strategy, simple option strategy, and all the way up to complex option strategies, everybody inside the group has access to my full options course. It's about 5 hours long. Come check it out. We'd love to have you. Now, one last thing about options. When you are buying options, it is known as a debit. Okay, for example, if the price is $40 and you are buying a $60 strike for 1 month out, and the premium is $1, your total debit would be $100 per contract because one contract equals 100 shares. That money comes out of your account. Now, the price is 40, your strike is 60. If the price just stays at 40 or goes to 45 and the option contract expires worthless or out of the money, your max loss is that $100, the debit that you paid. However, when you're buying options, your gains are infinite. If the price goes to 80, your gain might be $20 to $21 per contract. If the price goes to 100, it might be 40 to 43. If the price goes to 200, it might be 145. And so forth. Your gains are absolutely infinite. Now, remember, we just talked about inverse. When you are selling options, it's the exact opposite. You are getting a credit, meaning when I am selling an option, if I were to sell that same exact option I just explained to you, I would be getting a credit of $100 into my account. And therefore, my gains are max at that $100. However, my losses are infinite, the exact opposite. So remember exactly what I am explaining to you while I explain the bet against AMC. Let's take a look at exactly what this bet was. This is Unusual Whales. I like to look at his services and platforms for all of my options data. And as I was scrolling through this, this was actually brought to my attention by somebody else inside the group, and they asked for my opinion on this. And it took me a little while to really try to figure out exactly why somebody would take this bet. So take a look right here. You have your premiums. I always try to look at anything over $100,000. And my reason for that is very simple, because when somebody is placing a bet of over $100,000, I always try to think that there might be an insider or somebody that knows a little bit of information that I might not know of. So that's why I always look at this. But here you see 3 bets placed at the exact same second. And if you look here, you can see these up down arrows and it says the trade is part of a multi-leg option strategy. So this was the same fund that had placed this bet. And you can see there an insanely deep in the money call that were sold. Okay. And they collected a premium of $69 million. Now, there's a couple of reasons why they could have done this, okay? Now, there are about 21,000 contracts, which puts them on the hook for 2.1 million shares. Now, if they were bearish against AMC, I could not really understand why they would even take this bet, but let me just run down a quick scenario for you. So they're on the hook for 2.1 million shares. And let's say the price stays at $40. At the end of this, they would be on the hook for $84 million. But don't forget, they already collected 1, 2, 3, 4, 5, 6, a premium of 69 million, meaning their net loss would be $15 million. Now, if the price was a little bit different, let's say the price went down to $30, they would be on the hook for $63 million. So therefore, they want the price to go down. But why wouldn't you just buy a put if you want the price to go down? Why would you put yourself with infinite losses? Now let's take another opposing look. If the price went to 2.1 million times $100, okay, they would be on the hook for $210 million. When you minus the 69 equals $141 million. And that's only if the price went to $100. So they're making their losses infinite. So in my mind, I cannot wrap around why somebody would logically do this as a bearish bet. So here is my other theory, besides the abuse of the options chain that we've talked about before, is take a look at this. So if somebody was to take a look at their portfolio or their positions, because don't forget, these hedge funds are running other people's money, and they saw they had numerous different positions, and I just named a few here, but you have, let's say, General Motors, you're up 12 million, you have Apple, you're up 17 million, you have Tesla, you're up 24 million, and let's say you have a bunch of different stocks, maybe up 8 million, maybe down 10 million in a few of them. All right, nobody's green on everything. Another ones you might be big on, up 40 million. But then you get to AMC. And because you sold AMC short, you might have averaged up on your position, but you are still down $100 million. And if somebody were to see you were down $100 million in a position like AMC, where the price has stabilized very strongly now at that $40 level, let's say between the $36 and $42 level, has stabilized very strong, you are putting yourself at a very, very big risk. But now remember, they sold 3 massive chains here for a total of a $69 million credit. Now, when you sell an option, and I don't know if you guys have ever done this before, you get a credit that temporarily appears to your portfolio. So if you take a look at what this could be, okay, they have calls sold a total of a positive of $69 million for the premium collected, making their total position look like an AMC, only down $31 million. Now, that is a hypothesis or a theory that I have against AMC. I'm going to monitor this very closer. That's it for this video, guys. I'll see you in the next one.